Going across to our big conversation this morning, Ravi Dharamshi, founder and CIO of ValueQuest Investment Advisors with us. Ravi, great to have you on and so much to unpack and talk about. I want to talk first to you about how you're seeing the new labor codes coming in, not just from the impact of companies and on the economy. Of course, I'll hear about all of that as well, but as a sign of continuing reform by the government and how markets will be looking at that.
Yeah, good morning, and thank you for having me on the show. And I think, yes, you hit an important point over there. From the point of view of continuing the momentum on the reforms, it was absolutely a must. For some time now, some of the reforms related to the labor market, farm market, judiciary have stalled since a while, and there is an urgent need to push them through. So, from that perspective, it's a welcome relief, and the fact that there is enough room available for the state to form their own policies and their own rules adds a lot to the overall regulation. And I think this will do a world of good for India. Of course, I mean, it was in the coming since a while, and we are just glad that it has come through. And also in the perspective of the overall cyclical recovery in the economy that we have been waiting for, I think this is an added push that will add to the overall federal competitiveness in the economy. So the states will competitively frame regulations which are competitive versus other states, so that will hold us in good stead.
Ravi, at one point I want to make over here is earlier as well, you had started investing in quick service restaurants. Your exposure was pretty okay. And at that point in time, you had also noted that your real wages are still below pre-COVID levels. And that was a conversation, everyone had at that point in time as well, whilst investing in discretionary spends, consumption. Taking that aspect now, would you still be a buyer in terms of your platform companies like Eternal, Zomato? How would you weigh on them versus valuations?
Yeah. No, thanks for that question. First of all, I won't answer the question related to any particular company. But as a space, I think now there is a first time there is a pivot away from only capex driven and supply driven, reforms towards maybe some amount of stimulus being given to the economy in terms of demand stimulus being given, and that holds the entire consumption pack in good stead. However, when there are couple of trends going around in consumption. One is the overall revival in consumption that we are anticipating. The other is the redistribution that is happening, where most of these quick commerce players are kind of cornering a lot of the profits in the consumption space. I think both the trends should pick up pace with the reforms being brought in. So I do expect the valuation to sustain. Of course, I do not. I will not advise, neither am I buying or selling myself. So it's not for me to comment on the whether it's a good buy or no. But I don't see a reason for these valuations to correct just because they are expensive.
Ravi, the big debate this morning and the big talking point is what's happening with the IT sector and IT stocks, where there seems to be a belief that there is now a second coming. AI has gone from headwind to tailwind. Wondering how you are looking at the Indian IT story.
I think IT is a reversion to mean trade. I don't see any structural, any structural trend panning out over here. For example, I think what happened is that last 4-5 months or maybe 6 months, globally the only trade in the world had been the AI boom. And at that point of time, India did very, very poorly in a relative sense because the world over the AI stocks were booming and we did not have any AI stocks to talk of. In fact, India seems to be at least the narrative is India is an anti-AI play. And when I say anti-AI, essentially it is there is a negative reaction for AI because the IT services tend to get hit. I mean, there will be a limitation to the physical growth in the headcount in IT services company because of AI. Because coding is the first thing that will probably get commoditized, and the rates will crash dramatically. And it can lead to not only headcount growth stopping, but it can also lead to layoffs as well. So those are the concerns on the IT side. Now, in the past few days, we have seen that the global AI boom seems to be waning a little bit, or at least there are some question marks emerging on that. And that's where we see that now probably the IT services company are getting another lease of life in terms of being an anti-AI play. But honestly, I don't see this as any kind of a structural play. It is at best a reversion to mean play, and one should look at it in that from that lens. And this is a mature industry, probably which is not going to witness high double-digit growth for I don't think it's going to happen. It's only going to until they completely reinvent their model. Right now, the IT services labor arbitrage model, I don't think can sustain in the AI age.
Okay, no, so that's a clear point on IT, that nothing has fundamentally changed. And that's interesting because we're seeing so many views ever since this morning. Another place where the view is divided, I would say, Ravi, is in the renewable energy space. And your fund has picked up some stakes in some of these interesting companies recently. There is also a question about whether valuations have run ahead of actual execution. Just wondering how you're looking at the space.
So I don't think there is a question as much on the renewable side in terms of valuation. I think the question is more in terms of the supply demand and more in terms of whether the sector can sustain itself without the help from the regulation. So first of all, on the regulation side, we are very clear. Yes, this sector needs regulation as a tailwind, and we are continuing to witness that. And what our case that we feel is that there is absolutely a strategic need for India to maintain support for these sectors over a long period of time. Given that, I don't see the regulatory tailwinds becoming a regulatory headwind in Indian market. Second thing that has been worrying everybody is the demand supply situation, and especially on the modules side, and also extrapolation of that cell will also get into oversupply by 27 by some estimates. However, we do feel that cell is a far more technological intensive business and process, and hence it will not be so easy. The ramp coming up of the capacities are getting delayed. Also, the ramping up of these capacities are also getting delayed. And the fact that the profit pools keep shifting from module to cell to wafer will also hold the integrated companies in good stead, is our base case over there. So at this point, we should not, I mean, we are not too worried about the fact that there is oversupply in modules or there is a potential oversupply in cell at some point in time. But having said that, one cannot deny that these are all regulatory driven sectors, and a lot of the companies are coming to the market to get listed. And if everybody manages to raise money, that automatically means that a lot more capacity will be coming on stream. But to just conclude the point by saying that it has not been easy for some of these companies to raise funds. We saw one of the a company from the renewable space that barely could scrape the IPO through. That
Correct.
tells you that investors are being discerning, and not everybody is getting just by announcing a project, you're not getting money to fund that.
Ravi, that's an interesting point you make, because I want to tie that up with the IPOs which are coming in with exorbitant valuations right now. If you talk about even the kind of subscriptions they get, very strong, and then post-listing is when you see the real picture. Sometimes, obviously, they don't really even hit the issue price. Two, the quarter that immediately follows post-listing is what tells you the real story when the company actually reports a loss. How would you advise investors to actually trade or even look at any of these IPOs which are coming in at such high valuations right now? What is your view?
So first of all, I would not advise any retail investors to just participating in IPOs for the sake of a listing pop. That's not what these markets are meant for. And second of all, I would say if you are unable to understand the valuations, please, one should not participate in that. However, having said that, I have not participated in some of the IPOs where I could not understand the valuation, and those IPOs have gone on to give substantial return post listings as well. So who am I to say that that valuation was high? Valuation is an opinion, and opinion can be wrong as well. And PE multiple is not the only judge of valuation. It is but and one shorthand for judging a valuation. So at what stage of the industry evolution that company is, what stage of the evolution that company is, has it managed to raise the funds in the past? Does it have the wherewithal to execute its next 3 to 5 year growth journey? And what would be the in the 3 to 5 years, what is the kind of possibilities that that company can achieve in terms of size and scale and profitability will determine whether those valuations will sustain or no. Now, in the short run, any opinion can be right or wrong, but what will eventually matter is whether in a 3 to 5 year time horizon, some of these valuations are sustaining or no. I mean, again, I would reiterate that even I have not participated in some of the valuation IPOs where valuations are hard to explain, but I still don't look at it as a sign of a froth in the market or something that will lead to correction in the secondary market.
I'm wondering, Ravi, and this is something which will be very useful for our viewers this morning. When you look at all of the IPOs that come in, and then you invest in some of them, you don't invest in some of them, and you of course have the opportunity as an anchor investor. What are the parameters that you apply, or the filters that you apply before deciding on whether to go into an IPO or not?
No, great question. We have our framework. So number one, what we look for is the business profitable, unit economics are in place, and is this, if not the final fundraise, but is this like the company is coming to the market uh, for genuine valid reasons in terms of capex, and not it is not coming at the point in time where some of the unit economics are still not in place, and they might, if they don't reach that unit economics in a 18-24 month period, they will have to come again to the market to raise funds. Those kind of companies we definitely avoid, where the fundraising is of perpetual nature. Second, what we want to see is that there is a high stake of the promoters even post listing. That does give us a lot of confidence that this is not fly by night operator, or they are not looking to cash out. That's not the attitude. The business needs money, and there is a little bit of OFS can be part of the IPO. That's not a problem at all, but it cannot be the only thing. There are some companies where it can be 100% OFS also, but at the same time, the business model is strong and the promoter stake still remains very high. Post that, it would qualify for something that we would look at. Third thing, I mean, what we want is a genuinely differentiated business model, because finally, what excites us is not the near-term listing gains, but a business that we want to own for a 3-5 year period. And from that perspective, if we can find a franchisee which has some kind of a competitive advantage and a moat, and that can survive the competition in the short run, in the medium run, those are the kind of business models that really excite us, and that's where we would want to participate.
So Ravi, I would want to tie this up with companies where, say for example, you've put in money in few of the companies pre-IPO or at IPO stage, and now they're not really doing well. What would you do with such companies? And I'm sure there might be far and few that do come to your radar as well, that, okay, these are few companies like, say, I remember a conversation with you where you did say you have a stake in Vari Energies as well. Now, that's a company which is absolutely flat. That's a sector which you're bearish on right now. A few others which you would have looked at pre-IPO. If they are not doing well right now, what's that action that you would advise investors to take in a similar scenario?
See, for us, it always remains a longer term picture that we look at. Any 3 month, 6 month, 12-month period also can be tough. And for us, that is not a reason to be entering or exiting a stock. We always look at it from the point of view of rolling 3 to 5 years. And if from that perspective, if we feel that the company still has the ability to grow its profits more than 15-20% and compound it, and the valuations are not exorbitant, we would continue to hold. It has nothing to do with what the price at which I have bought. The incremental decision depends on whether the business momentum is still there, earnings growth will come through in a 3 to 5 year time horizon, and whatever the hypothesis that we had built for ourselves in terms of what kind of growth and profitability the company can achieve, as long as it is delivering on those with a little bit small margin of error, I think we would continue to hold on to those positions. So for us, the prism to look at is 3 to 5 years. It is not what happens in next 3-6 months.
Okay, thank you so much for that. Ravi Dharamshi there speaking very clearly on new IPOs, what filters you should apply, investment opportunities and more. Always a pleasure to have you on, Ravi. Thank you so much for that.